Now a look at stock investing rules. According to my next guest, now isn't the time to be buying shares in any great volume. That's based on his assessment that there simply aren't many A1 businesses out there that can be bought cheaply. Tonight he'll run us through the importance of calculating a business's cash flow. Independent investment expert Roger Montgomery now joins me in the studio. Hey Roger, what I'm saying is your calculations give you like a quality measure of the kinds of businesses that more times than not are going to do well in bad times as well as good times.
Correct. Well, okay. I'm trying to find, what I'm trying to do is, I'm trying to isolate quality, I'm trying to define quality two ways. Yeah. Stability of balance sheet and therefore predictability of default, if you like, or collapse. Yeah. So I want businesses that aren't going to collapse. Yeah. And that's to do with the stability of the balance sheet. And then what I'm interested in is predictability of performance, the continuation of the performance. Okay,
right. Now let's get to the action now. Today we're going to talk about, you summarise what...
We've done this a couple of times, haven't we? We've talked about cash flow and both you and I have received a couple of emails where people have said, could you just get him to go through that again? I didn't quite get it. Yeah. So that's what I'd like to do. Now, what we know is that companies report profits and we read those profit and loss statements. They are, more often than not, a construct. They're an accounting construct. And accountants have to, and despite what everyone says, accountants are very inventive. Yeah. And they've created these wonderful, they're wonderful reports that might not reflect the economic reality of running a business. So let me give you a classic example. Airlines, for all intents and purposes, don't make an economic profit. They make an accounting profit, and that's because there's an accounting item in there called depreciation. Yeah. And depreciation for Qantas might be $1 billion. It's a bit more than that.
An airplane is expensive, and we're knocking off a third every year or whatever it might be.
But what they do in the report is they say, well, depreciation is going to be based on the 20-year useful life of the plane. Yeah. We're going to depreciate it on what's called a straight line basis. So we're going to put an equal dollar expense against whatever it is against the plane over 20 years. But in fact, it'll be less than that because there'll be, let's say, a 25% residual. But and that's an expense, so that reduces the profit figure. But I think that expense would be much bigger if we weren't basing the cost on what the plane cost 20 years ago, because the new one that we're going to buy as an airline is going to be much more expensive than the one it replaces. Yes. So you imagine we've got a 19-year-old plane, the new one that we buy is going to be much more expensive. So really, what we need to do is we need to do our own accounting invention, take out the depreciation and put in some sort of provision for buying new planes.
Which will be bigger, and therefore
much bigger.
It will hit the profit.
It'll hit the profit. There'll be no profit there. Okay. And then, so people say to me, "Oh, Roger, but Qantas is a good company and pays me a good dividend." Well, where does that? If they're not making an economic profit, where does the dividend actually come from? The company has to borrow money, or it has to raise fresh capital. We're going to talk about that when we look at cash flow.
Okay, let's get to it.
So let's look at the first table, shall we? The first table's a not this one, the other one. We'll wait for that to change over.
Yep.
Yep.
There's you and me on the TV.
So the next one, here we go. Here's our theoretical company. Thanks for that, guys. So to calculate, imagine you're running a business and all the transactions were cash. Yep. There was nothing else but cash. Yep. So forget about everything else on that table except the first line cash.
100,000 this year.
So we started the year with 60,000, which was the end of last year, 60,000, and we end the year with 100,000. Yes. Now the difference between those two numbers, you can see there's $40,000.
So the 40,000 better year.
We were up 40,000. So our this is after tax and after all the expenses, everything's been cashed. So we've got a $40,000 profit. But when we dig a bit deeper into the balance sheet, we see that the borrowings have gone up. We had borrowings last year of 160,000, and they've gone up to 200,000. Now, so what that means is we've borrowed an extra $40,000, and we've put that in our bank account. Yes. That's been transferred to our bank account. So that $40,000 increase in the bank account is actually debt. The debt's gone up by 40 grand. So really, at that point, we've broken even. Yeah. So we have actually made a profit.
Some people might have presumed it was a better revenue result for sales, but what you're saying in this example, they've done better because they've borrowed money.
And they actually haven't done better at all. Yeah. In this case, 40,000 minus the 40,000, if you like, is zero. Now, what we also know is they've raised some money. Have a look at the equity line there. We $280,000 a year ago. We've since put in an extra $20,000 So we've injected extra capital.
Which is a liability when that goes in.
So really, if you look at the bank account, it's up 40 grand, but we added 40 grand from borrowings and we added $20,000 from extra capital that we've put in. So really, we're down $20,000, aren't we?
So that 100,000 figure was very misleading.
It was. And look at the final figure. The final figure there is the dividends that we actually took out during the year, cash dividends. We took out $30,000. So if we added that back in, we'd end up with a total of $10,000, which is at the bottom of the right-hand column there. So that $10,000 represents the real cash profit of the company for that year. Now we can. This is a hypothetical example, but I can get the annual report of any company, as everyone, all your viewers can, and you can do this for a listed company. So if we look at the next table. This is a real company, a company that people would have heard of. This is ABC Learning Centres, and all I did here was exactly the same calculation from ABC Learning Centres annual reports going back to 2000 all the way up to June 2007, and you can see that in every single year, look at that bottom line there, in every single year except 2001 where there was a $2 million increase in cash, every other year it lost money on a cash flow basis. So there was no legitimate reason for owning shares in this particular company, and you would have known right through its life.
And it was massive around 05, 06, and that's clearly when they were borrowing, going overseas and buying...
Now I should add that this wouldn't be, for a company that's expanding and it's acquiring other businesses and it's acquiring shops or whatever it is, or learning centres, this wouldn't be a problem provided the return on equity stayed high. But where you have a combination of this kind of cash flow and declining or very low rates of return on equity, for example, lower than a bank account, less than, let's say, a term deposit's 7 or 8%, so less than that, you don't want to go near those sorts of companies. It's a very simple rule, really easy to calculate, and it works.
Most definitely. Next time you come on the program, I want you to find, say, 5 companies that will pass your test now.
Sure.
All right?
Okay,
and
no problem.
Because a lot of people still, they now would understand it, they still wouldn't have the courage to go to a balance sheet. Some people will, and that's the value of this exercise. But get 5 companies that actually pass this test.
All right.
And we'll watch it as well over time. Because I know a short-term test is not relevant for you, but a lot of our viewers would love to know what you think of 5 companies that pass this test.
I should say that's the quality aspect. So we're interested in buying quality businesses, but there's a second overlay, and that is, are they cheap enough to buy? And I have to tell you, at the moment, I put this up on my blog only yesterday, there's only 3 companies at the moment that I think are top quality and still cheap. Everything else seems to be expensive at the moment.
Name them for people who've never seen you before and don't realise how good you are.
One of them's JB Hi-Fi, and another one is Oriton Group. So we've got 2 retailers, and off the top of my head, I can't remember what the third one is, but
extraordinary that you can't remember.
I know, it's on the blog, it's there on a table for everyone to see. I've forgotten it.
But when you come back in 2 weeks' time, you actually will have 5, and probably those ones will be
5 good quality businesses. They're probably going to meet the test because they're A1, A2 type businesses. But we'll get another 3. We'll get another 2 or 3.
I think a lot of people would love to track them on the way through.
Sure.
And also, you said Harvey Norman some weeks ago passed one of the tests. I can't recall.
It was the quality test.
Yes, okay.
It's the quality test. It's a little bit, I'm looking at it, it's a little bit expensive. It's still expensive. Look, the reality is Australian stocks generally, over time, tend to be a little bit more expensive than my valuations. And the reason that's the case is we've got 3,000 funds chasing about 600 companies that actually make any money. So generally there's a higher price than my values. But what that means is occasionally people get scared, they panic, they dump good quality businesses. And I used the analogy the other day, we're a little bit like, value investors are a little bit like goldfish in a pond. We're waiting for that odd crumb to jump to fall down on the surface of the water, and we'll grab it.
Fantastic.